Okay, so today we have a bonus episode of the rental house versus high income ETFs. So I'm going to call this one episode 7.3.1. I've mentioned before I worked in the tech industry and we would have releases of some training software and we would use the release numbers like 6.0, 6.1, 6.11. So this is a minor update. So 7.3.1. Just explain that. I won't go into details what this experiment is about because if you've been watching my episodes, you already know that and you're getting sick of me telling you that every week. So, but I will ask you if you will subscribe if you haven't done that. We won't spend much time about that. So, a couple questions I want to address in this short video. The reason I'm making this video and not including this in the regular weekly videos is because I like to keep these videos about 10 minutes long. And if I go down a rabbit hole in the other videos and it end up being 20 minutes long and nobody wants to sit through that. You might not want to sit through this either, but if you do, I appreciate it. Here's some questions that people have been asking me. Are you going to sell my QDTE? Are you going to sell AIPI? Why do you start buying SPYI or SPYI? And how have the funds done recovering from the dip? So I'm going to try to answer those questions in this video. And just to answer them quickly, I'm going to sell QDTE. No plans to do that. I'm going to sell IPI. No plans to do that. I'm going to buy. Why did I buy SPY? Because SPY has done pretty well as far as hanging onto the NAV, and it's very consistent, 12 to 13% per year. And the NAV actually increases along with the SPY. So when the SPY dips, the SPY will dip. So I'm looking for a little more consistency to add to this portfolio. And let's jump in here and look at some returns here. So this is from the dividend tracker. It's a website where you can tie it to your brokerage account and pull in the information and gives you some additional things I like to look at. And one of the things I like to look at is yield on cost. So I have these shares, 2,700 QDTE, 600 API, 500 giax, and 200 SPY. These are the prices as of today. These are the average prices. So the yield on cost is based on what I paid for it. And the dividend yield is based on the cost of today. So if I bought something for $100, it was paying $10 per year dividend, that's 10%, let's say. If my price of that stock goes to 50, but it still pays a $10 dividend, people say, oh, you're getting 20% on that. That sounds really good, but I've lost half my original investment. So the yield on cost will take into consideration and calculate what the return is based on what I paid for the shares or whatever. So the reason why I wanted to point this out today is people are saying you can sell QDTE and AIPI. If I sold those today thinking I need to take funds from that and dump it into SPYI or something different, if I panic and sell, the thing is, if I sold that and invested in something else, could I earn 34% or 31% on those new investments? And the answer is probably not. Depends on how much risk I want to take. So since this is recovering, QDTE and AIPI and giax, and they're all recovering, I'm just going to stick to it and see if the NAV recovers close to what it was before. Even if it doesn't, eventually the dividends will make up for the loss percentage and it will recover that way. By looking at this, you can see what my thinking is. I'm probably not going to get close to 35% on anything else I invest in. So I might as well just stay with QDTE. And I'm under the assumption that we're not going to have another dip and the NAV is not going to erode more than what it has. In fact, I'm expecting it to recover slowly. So that's where I'm at. But new investments, I'm going to put in SPYI from this point on to further notice or until I change my mind. So let's look at some more things here. So I'm calling this slide the recovery of my covered call ETF. This is from totalreturns.com. This is from about when I started this experiment. 1st of November 2024 until today. That's today's date. And I threw SPY and QQQ in there to compare things to. So total return, this is the net asset value plus the dividends or distributions that have happened since this date. And you see AIPI is at 1.29% compared to SPY being 2.68. Then you have QQQ here a little bit over 5. giax is up 1%. QDTE is actually down 1%. And SPYI is up about 2%. So that's total returns, including the distributions and net asset value since November. Now let's look at something else here. So this is what happened between November and April 7th, which was about the bottom when the SPY hit the bottom and it started to recover. And it's been recovering since then. So the dip that it took from the time I started this experiment till April 7th was the SPY was down 12%, QQQ 14%, and you see AIPI down almost 16, giax down 16, QDTE down 14, and SPYI down 11. So this also includes the dividends and distributions that these covered call ETFs received during that time. But you see, with the payment of the distributions, it kind of buffered the downward a little bit. So QQQ being down 14%, QDTE was down 13.91% during that same time. So about the same. Now, if you just looked at the NAV, QQQ compared to QDTE would have dropped quite a bit more. But if you're looking at total returns, it's pretty much about the same. Same thing with SPYI and SPY. That's within 1% point of the same dip. So let's see how things recovered since that same date. So since April 7th of 2025 till now, which is about 6 weeks or so, this is how things have recovered. SPY is up 17%, and SPYI is up 14.72%. So once again, this includes the total distributions, the NAV, and the returns, the dividends and distributions that are being paid out. QDTE is up 14% compared to QQQ at 22%. So QDTE has not recovered nearly as well. I wish it did, but it hasn't. But I'll just have to live with that, I guess. AIPI is pretty close to recovering at the same pace, and so is giax. So I'm pretty happy with most of all these, except for QDTE, which is where I have most of the money. It is what it is, and I guess I'll have to live with that. So what I want to do is do an update. And I was curious myself exactly how things were recovering, and I would share that. People are wondering, like, why you sticking with certain funds, QDTE or giax or AIPI, when the market's coming back. You might be asking, are those recovering along with the market, or are they lagging way behind? And so the answer to that question is yes, most of them are recovering pretty well with the market if you include the total return, except for QDTE's lacking a little bit behind. But eventually, it may take a little longer, but hopefully it catches back up to where it used to be. It might not ever catch QQQ, but that's fine as long as it recovers and gets back to where I'm comfortable. So did I answer those questions? How have the funds done recovering from the dip? I think I answered that. Why did I buy SPY? I answer that. And I answered those two questions. And jumping back to this slide, this is from the dividend tracker. I do have an affiliate link, but I don't share it. I'm not trying to make money off that. If you want to look at that, there's a free version of this you can try, but you have to enter the funds yourself. If you pay, it will link automatically. And I do have about 8 different accounts with a lot of different things, my IRAs, my granddaughter's accounts, and different things. So for me, it's worth it. If you only have one account, maybe a few things might not be worth it. So check them out. Give them a try if you want. And finally, a reminder, subscribe if you haven't done so. If you find this helpful, I'd appreciate it if you did subscribe.